Most people enter trading believing that success comes from finding the perfect strategy, the perfect indicator, or the perfect mentor. But the uncomfortable truth is that trading is not primarily a technical skill. It is a psychological and structural game designed in a way that naturally transfers money from the impatient to the patient, from the emotional to the disciplined, and from the uninformed to the informed. When you hear the statistic that around 90% of traders lose money, most people assume it is because those traders are lazy, unintelligent, or unwilling to learn. But that assumption is completely wrong. The real reason 90% of traders lose money is because the entire environment of trading is built to exploit natural human behavior. And unless you understand that reality, you will repeat the same cycle over and over again, regardless of how many strategies you learn. The first and most important thing to understand is that the market does not reward effort, intelligence, or good intentions. It rewards correct behavior under uncertainty. And humans are biologically wired to behave incorrectly in uncertain, high-pressure situations involving money. When a new trader opens a chart, they're immediately exposed to constant movement, flashing prices, and endless opportunities, which creates the illusion that action equals progress. But in reality, the more frequently you act in the market, the more you expose yourself to emotional decision-making, transaction costs, and structural disadvantages that professional traders already understand and exploit. One of the biggest lies in trading education is the idea that more trades mean more opportunities, when in fact, more trades usually mean more mistakes, more emotional fatigue, and more losses. Professional traders understand that trading is not about participation, it is about selectivity. But beginners are never taught this properly, so they overtrade, chasing every small move as if it is a once-in-a-lifetime opportunity. Another critical reason most traders lose money is because they approach the market with the wrong objective, focusing on winning individual trades instead of executing a repeatable process. The market does not care if you win or lose on any single trade, but your brain does, and that emotional attachment to outcomes creates fear after losses and overconfidence after wins, both of which lead to inconsistent behavior. This inconsistency is the silent account killer that most traders never recognize because it disguises itself as normal decision-making. After a winning trade, the trader feels validated, increases risk, trades more frequently, and ignores rules, while after a losing trade, the same trader hesitates, cuts winners early, or avoids valid setups entirely, creating a destructive feedback loop that has nothing to do with strategy quality and everything to do with emotional regulation. Another reason 90% of traders lose money is because they misunderstand risk completely. Most beginners believe risk management means simply placing a stop loss, but true risk management is about position sizing, expectancy, and survival over a large sample size. The market is a probabilistic environment, not a deterministic one, and any single trade outcome is largely irrelevant compared to the long-term distribution of results. Yet most traders emotionally treat each trade as if it defines their skill level or self-worth. This causes them to take trades they should skip, move stops they should respect, and close trades they should let play out, all because they are reacting to short-term emotional discomfort instead of following a long-term plan. The illusion of control is another powerful psychological trap that destroys traders. When someone spends hours analyzing charts, drawing lines, and watching videos, they feel productive, but analysis does not equal edge. An edge is a statistically proven behavior that produces positive expectancy over time. And without clear data, journaling, and strict execution rules, most traders are simply guessing with confidence. The market encourages this illusion by occasionally rewarding bad behavior, such as over-leveraging or impulsive entries, which conditions traders to repeat actions that will eventually lead to catastrophic losses. This random reinforcement is extremely dangerous because it trains the brain to associate emotional decision-making with reward, even though the long-term outcome is negative. Another overlooked factor is that most traders never truly accept uncertainty. They want certainty in entries, certainty in direction, and certainty in outcomes, but the market offers none of these consistently. Professional traders accept uncertainty as a cost of doing business, while amateurs fight it, searching endlessly for confirmation, additional indicators, or external validation, which delays decisions and increases emotional stress. This inability to accept uncertainty leads traders to hesitate on good setups and chase bad ones, always entering late and exiting early, which is the exact opposite of profitable behavior. The structure of the market itself also contributes to widespread failure. Financial markets are not neutral environments, they're competitive systems where liquidity is required for large players to enter and exit positions. This means that retail traders, by nature, often provide liquidity rather than consume it, placing stops in obvious locations and entering trades at emotionally driven points. When price moves against them, they assume the market is manipulated or unfair, without realizing that their behavior is predictable and structurally disadvantaged. Education focused only on indicators and patterns fails to address this reality, leaving traders confused as to why setups that look perfect still fail. Another major reason traders lose money is unrealistic expectations. Social media, marketing, and highlight reels create the belief that trading should be fast, easy, and highly profitable, which sets traders up for disappointment and reckless behavior. When reality doesn't match expectations, frustration builds, leading to impulsive decisions, revenge trading, and abandonment of rules. Consistent profitability in trading is boring, repetitive, and emotionally neutral, but most people are unconsciously seeking excitement, not consistency, and the market punishes those who treat it like entertainment. Time is another misunderstood element. Most traders underestimate how long it takes to become consistently profitable and overestimate what they can achieve in a short period. This impatience leads to strategy hopping, constantly changing systems after small drawdowns, never allowing statistical edges to play out. Every new strategy restarts the learning curve, ensuring that the trader remains permanently inexperienced despite years in the market. The truth is that most traders do not fail because they lack information. They fail because they lack structure, discipline, and emotional resilience. Without a clear plan defining when to trade, how much to risk, and when to stop, the market becomes an emotional battlefield rather than a professional environment. Until a trader shifts their identity from someone trying to win money to someone executing a process, losses will continue regardless of technical knowledge. Trading exposes psychological weaknesses faster than almost any other profession, and unless those weaknesses are addressed directly, they will dominate decision-making under pressure. This is why 90% of traders lose money, not because they are incapable, but because they are unprepared for the psychological and structural realities of the market.